The crypto land and fiat world are these two worlds. Now, we've talked about GDP is slow in fiat world because of aging populations, debt, and lack of productivity. But over in crypto land, the population's growing at 42% a year in a year when the economy went down 80%.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discuss about crypto market. According to Raoul Pal, this is a wonderful way to frame everything, and it makes it easier to understand what is going on easier for those who are not very knowledgeable with cryptography or are somewhat jaded about it. We discuss two worlds. This comes before the actual world in which we both reside. Be it in my world of the Cayman Islands or your world of North Carolina Islands, followed by the virtual communities where we reside in the cryptocurrency we've already discussed, GDP. But these two realms are crypto land and fat world slow in the fiat world because to declining productivity, debt, and aging populations. While over in crypto and the population's 42% annual growth in a year, during which the economy down 80% productivity gains, are observed as new applications of blockchain technology, daily introduction, and you've recently paid off the debt from the prior cycle. So in an exceptionally quickly expanding emerging market, what occurs is that you're now, when Franklin Templeton and fiat world players put up offices in crypts, fiat, or Franklin Templeton is reportedly establishing offices for Fidelity TRS. We adore this location, believe its economy is vibrant, and wish to construct things here. Then the ETF appears, consider it as a trading agreement between the fiat world, and lots of things Raoul Pal discuss, so please watch the video to end, and share, subscribe our channel Everyday Finance. Thanks.
So crypto side has been, outside of AI, the fastest adoption of any technology in all of humanity. It has been following a perfect log trend. And what was it staggering is last year, the number of active wallets in crypto grew 42% in a year when the market went down 80%. That's oh my God. We're now at 516 million users. By the end of 2030, we'll be well over 1 billion users, maybe 2 billion users. So it is a very prevalent technology, and it's happening this cycle everywhere, kind of everything everywhere all at once. The banks are using it. They're already trying to settle securities on it. They're using it for payment systems. We're seeing Visa using it for payment systems. We're seeing mega brands like Mercedes-Benz or Starbucks using Web3 NFTs. We're seeing Hermes, LVMH as a broader company adopting this. We are seeing the ongoing adoption globally of cryptocurrency as an investment vehicle. We're seeing the institutions investing in it. I've had on my show Texas teachers, they were pioneers in the space. We've had Franklin Templeton, Fidelity. These are big companies. Now we've got BlackRock. So what is going on here? Here's a nice way of framing all of this. And it makes it easier for people who are kind of crypto cynical or don't really understand it. We have two worlds. We talked about this before. We have the physical world that we live in, your world of North Carolina, or my world of the Cayman Islands. And then we've got the digital communities that we live in. The crypto land and fiat world are these two worlds. Now, we've talked about GDP is slow in fiat world because of aging populations, debt, and lack of productivity. But over in crypto land, the population's growing at 42% a year in a year when the economy went down 80%. You've got productivity improvements as new uses of blockchain technology get introduced every day. And you've just wiped out the debt from the previous cycle. So you have an extremely fast-growing emerging market. And what happens is you're now seeing fiat world participants set up offices in crypto land. Franklin Templeton, Fiat, Franklin Templeton, Fidelity, TRS, they're setting up offices there. So we love this place. We think it's a dynamic economy. We want to build stuff here. Then the ETF comes along. The ETF people need to think of as a trade deal between fiat world and crypto land. So it's a trade deal to allow capital to flow into this other economy. And as that economy, crypto land, grows fast, a lot of money is going to go down through this pipe of the trade deal, which is the ETFs, and then will flourish within that economy. So we're seeing this giant sucking sound of people seeing this economy. It's much like when China came onto the world stage. Is everybody flooded there? Everyone put their capital there. Everyone built offices there because they could see the big opportunity. Well, this is the fastest growing economy we've ever witnessed. It just happens to be a digital one. It has its own system of currency, its own interest rates and central bank policy. It has a financial system, which is DeFi. It has states like Bitcoin, Ethereum, Solana, whatever it may be. These are states within crypto land. And those have different policies. We have taxation systems within crypto land. We have assets, NFTs, within crypto land. And it's just because they've all been more attractive over time, it's sucking in more and more of fiat world into it. And eventually, I think it basically subsumes fiat world.
According to Raoul Pal, asset prices appear to be rising. But when you split, say, the S&P 500, gold, or real estate by the Fed balance, they aren't actually rising sheet. They've been unoccupied since 2008. And Raoul Pal learned from that process that, in contrast to the depreciation of currency, only two assets, technology stocks and cryptocurrency, since both were on a secular rise, everything was happening as planned cycle, which revolves around the debt refinancing cycle, coincides with the US election cycle, is precisely the same as the Bitcoin halving cycle, meaning that all of these cycles occur at the same time each and every time. So here we are at the bottom of the business cycle. Businesses are laying off employees in this type of recessionary period. As inflation is beginning to decline sharply, the technology and cryptocurrencies forward-looking markets valued in a recession from the previous year. Let's back to the Raoul Pal interview.
The world hit an inflection point in 2008, which was the global debt crisis. And we get the ramifications that spread on in 2012, the European crisis. And that continues to rumble on to this day. What happened back then was something remarkable. Is if we think about how GDP is created, the growth of economies, it's population growth, productivity, and debt growth. We've had aging populations in most of the Western world. The US is less aging than others, but still aging. But debt growth in 2008 stopped, basically. And we had a debt jubilee. Now, debt jubilees, most people would think of, you forgive all the debts. We didn't. We did this magic trick, which we said, you don't need to pay the interest on the debt. We'll make it all zero. And every central bank around the world cut interest rates to zero. Okay, that created an opportunity for every government to refinance their debts. So they all refinance, and they refinance them in this 3 to 5 year time horizon. And that set off a cyclicality to the economy that we've never really seen before. That every 4 years we get economic weakness, the increases of the balance sheet and use of interest rates as they come to refinance the debt. What I found out in my work that's become quite well known called the Everything Code, I found out that, in fact, the use of the central bank balance sheets was used to pay the interest on the debt from the previous cycle. And this will become relevant in a second. So they're monetizing the interest payments, which is pure debasement of currency. And debasement of currency means that the denominator, the purchasing power of that currency, goes down, and it makes the price of assets look like they're going up. But they're not really going up. when you divide, for example, the S&P 500 or gold or real estate by the Fed balance sheet, they've been flat since 2008. And I discovered within that process that only two assets actually have risen versus the debasement of currency. That was technology stocks and crypto. Both were in secular uptrends. So this, like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the US election cycle. It also happens to be exactly the same as the Bitcoin halving cycle. So all of these cycles are at the same time every time. So here we are today. Today, we're at the bottom of the business cycle. This is the kind of recessionary era. Businesses are laying off staff. Inflation is starting to fall sharply. The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. So they're at their lows. And everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December, and that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45% and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. That's when the weather kind of gets warmer every day, but sometimes it's raining and sometimes you've got a frost and other times it's hot and you're like, it's always confusing. That's macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing. And we should be in macro summer for all of 2024 and into 2025. And so my forward-looking basis is that the economy picks up, inflation keeps falling. I think it'll overshoot to the downside, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea, because we've just gone through a ridiculous rate cycle, kind of an unprecedented rate cycle on the back of the unprecedented inflation. That inflation, I think, was just driven by the pandemic. If you shut down, all demand and shut down all supply and then bring it all back on at the same point, you create chaos. Exactly the same happened after World War II. After World War II, suddenly everyone came back into the labor force and factories had to retool from making munitions to making cars and washing machines and whatever. And we got a massive inflation then. But then what happened is it worked its way through and we just had strong growth going forward. So that's where we are today. Go on.
Oh, no, you can continue.
So we've still got the problem remaining of that GDP formula. How do we pay for this bloody debt? Because it keeps going up. The higher interest rates go, the more bonds they have to issue, which is why I think they want to bring interest rates much lower than people expect by being so late in hiking, so they can undershoot and have the cover to paper over the cracks in the system yet again. And they'll use the commercial real estate and the banks as one of the excuses to do it, to start using the balance sheet. But we've still got the problems with the economy, is it's not growing fast enough to pay the interest on the debt. So if the economy on average is growing at 1.75%, and let's say interest payments on debt is about 2%, and the government's 100% of GDP in debt, that's all of GDP just to pay the debt. So what you need is to grow GDP. And to grow GDP, you either need the population to grow, well, that's not going to happen, or you need productivity to grow. That's technology. So productivity growth is what I'm really looking at. And it's not this cycle story, but by 2030, we will see AI solve for both problems. AI and the robots are new demographics. They're new productive units in the workforce of infinite scale. So we can now have an infinite population of productive people in inverted commas, and that will start driving productivity. The next part of the equation is we need to bring the cost of energy per unit of output down. And it won't come out of fossil fuel markets, it'll come out of renewable energy plus nuclear energy. If you lower the cost, the average per dollar barrel of oil price over the last 60 years has been about $40, inflation adjusted. But if you change to a new source of energy or bring in other sources of energy to make an excess abundance of energy, and you bring it down to $10, that has a massive multiplier. So my big picture is we're about to go through an economic revolution, but we're not finished with the downside of slow economies, and that's going to mean more and more use of the balance sheets, ongoing increase in asset prices, and this ongoing cyclicality of the economy. So there you go. That's, in my nutshell, there it all is.
So that's when Raoul Pal first noticed Bitcoin in 2012. It was the first macroeconomic strategy paper about Bitcoin ever produced. And Raoul Pal wrote it about how to value it. Raoul thinks this thing could be worth if it's valued in the same way as gold. If you value it like gold, then it's worth $1 million. Okay, so let's just pretend that Raoul Pal, a moron, discount 90% of it is worth $100 grand to me, and Raoul Pal say it was trading at $200. I bought it then as well because I thought this was the best macro risk reward I had ever seen in my entire career. When Raoul wrote it, a lot of people who were similar to me were global macro investors. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.